In this lesson, we have an overview of issuance and trading of bonds on the primary and secondary bond markets. Let's get started. Bond markets can be segregated into two main types: primary markets and secondary markets. Primary bond markets are markets in which issuers initially sell bonds to investors to raise capital. In contrast, secondary bond markets are markets in which existing bonds are subsequently traded among investors. Both primary and secondary bond markets are regulated by an established independent regulatory authority. The regulator is responsible for the structure of the markets and the credentials of market participants. In a primary market, issuers register with the regulators the bonds they wish to issue. They can be marked as a public offering or sold only to qualified investors as a private placement. Public offerings can be in the form of an underwritten offering, best efforts offering, a shelf registration, or an auction. In a secondary market, the majority of bond trading in the secondary market is made in the dealer or over-the-counter market. OTC markets are usually electronic trading platforms over which users submit, buy, and sell orders. An organized exchange provides a place where buyers and sellers can meet to arrange their trades. Let's go into detail on each of these markets. A public offering is typically done with the help of an investment bank. The investment bank assists the issuer in the various steps of a public offering. This includes determining the funding needs of the issuer, structuring the debt security, creating the bond indenture, naming a bond trustee, which can be a trust company or bank trust department, registering the issue with securities regulators, assessing demand and pricing the bonds given market conditions, and selling the bonds to investors. An investment bank typically sells the bonds through an underwritten offering or a best efforts offering. In an underwritten offering, the investment bank, termed the underwriter in this case, purchases the entire bond issue. The underwriter establishes the pricing of the issue and is responsible for selling the bonds to dealers who in turn sell them to investors. For smaller bond issues, one single underwriter may have the capacity to purchase the entire bond issue and take on the risks involved. But for larger issues, a syndicate of investment banks with an appointed lead underwriter is often employed. Such an offering can be referred to as a syndicated offering. If the offering price of a new issue is set too high, the offering will be undersubscribed. The underwriters will have to absorb the losses from the unsold bonds. Alternatively, if the offering price is set too low, the offering will be oversubscribed. If a bond issue is heavily oversubscribed, it may mean that the issuer is not getting a fair deal. Usually, underwriters aim at a small oversubscription because it reduces the risk of being unable to sell the entire bond issue. To assess market demand and therefore determine the appropriate pricing, underwriters can take various approaches. The underwriter can publicize through advertisements or through direct marketing and roadshows aimed at international investors such as pension funds and insurance companies. The underwriter may also approach large institutional investors and discuss with them the kind of bond issues they are willing to buy. These buyers are known as the anchor investors. The grey market is another way for underwriters to gauge investors' interest. The grey market, also called when issued market, is a forward market for bonds about to be issued. By monitoring the trades in the grey market, underwriters can have a clearer picture of the underlying demand for the bond's issue, and thus determine an appropriate issue price. In a best efforts offering, the arrangement is very much like an underwritten offering, but with one key difference. The investment banks do not commit to purchase the whole issue. Rather, the investment banks sell the bonds on a commission basis. So in this case, if the bond issue is undersubscribed, the issuer will not raise the full amount that it needs. In a shelf registration, a bond issue is registered with securities regulators in its aggregate value with a master prospectus. Bonds can then be issued over time when the issuer needs to raise funds. So, for example, the issuer registers with the regulators on 1st of January 2018 an aggregate of $6 million worth of bonds to be issued. At this instance, the issuer needs $2 million, so it issues $2 million worth of bonds to investors. The following year, it needs to raise $3 million. The issuer need not register another bond issue and go through the underwriting process. Rather, it can invoke on the existing master prospectus and issue another $3 million to investors. As such individual offerings under a shelf registration require less disclosure than a separate registration, only financially sound companies are granted this option. In some countries, bonds registered under a shelf registration can be sold only to qualified investors. Some bonds, especially government bonds, are sold through an auction. For example, US Treasury securities are sold through single-price auctions. In a single-price auction, all successful bidders are awarded the bonds and the price equivalent to the highest yield of accepted competitive tenders. The majority of purchases are made by primary dealers, which are financial institutions authorized to deal in new issues of US Treasury securities. Individuals can purchase through the auctions as well, but their numbers are not significant. Besides public offerings, another way to issue bonds in the primary market is through private placements. A private placement is typically a non-underwritten, unregistered offering of bonds. The placement can be direct between the issuer and the investors, or through an investment bank. Because privately placed bonds are unregistered, there is usually no active secondary market to trade them. As such, they usually come with additional yield to compensate the investor for the lack of liquidity. Large institutional investors, like insurance companies and pension funds, are major buyers of privately placed bonds because they do not need every security in their portfolio to be liquid, and they often value the additional yield offered by these bonds. Privately placed bonds are often issued in small amounts, at times by unknown issuers. As the bond's indenture can be negotiated directly with the investors can influence the structure of the bond issue. They include considerations like collateral backing, credit enhancements, and covenants. Secondary markets refer to the trading of previously issued bonds. While some government bonds and corporate bonds are traded on exchanges, the great majority of bond trading in the secondary market is made in the dealer or over-the-counter market. In an OTC market, dealers post bid and ask prices for various bond issues. The difference between the bid and ask prices is the dealer's spread. The average bid-ask spread is often between 10 and 12 basis points, but varies according to the bond's liquidity. An illiquid bond may have a spread of 50 basis points or more. Bond trades are cleared through a clearing system, just as equities trades are. Settlement is the process that occurs after the trade is made. Settlement for government bonds is either the day of the trade or the next business day, denoted as T+1. Corporate bonds typically settle on T+2 or T+3, although in some markets it is longer. And that concludes this lesson on primary and secondary markets, where we have an overview of the issuance and trading of bonds. See you at the next lesson, where we'll move on to the specific types of bonds.